Hello, ladies and gentlemen. This is Thomas Fross with Fross and Fross Wealth Management with your 2023 State of the Markets address. This is Tuesday, I guess, the February 14th, and last Tuesday at Everglades, we did this presentation before about 250 of our clients, and we recognize that some of you have busy schedules or you're traveling, and so you were not able to be present. So we decided to record this video for your benefit. So I hope you enjoy the presentation. As always, just a few disclosures. There's no perfect investment. Every investment comes with its upside and its downside, and we're not making any exact recommendations right now. So if you have any questions about anything that you see during this video, please make sure you reach out to our office. We'll be more than happy to address that. So just today's agenda, the things we wanted to get through. First of all, a brief review of 2022, what happened in the economy and the market and different sectors of the market, what performed well, what didn't perform well. What are some headwinds and tailwinds that we're expecting for this year, 2023? And lastly, what is our perspective here with your investment committee, which I think I zipped through, but our investment committee, just know that we're here for each and every single one of you. So I think as I think about summing up what we all wanted for 2022 after COVID and the lockdowns and the lack of traveling and seeing our families, I think we all needed just to get back to normal. And I think we were all expecting a nice sunshiny day, so to speak, for the calendar year. And it kind of reminds me of what happened with Hurricane Fiona, when all these people woke up in Florida hoping that the weather would be fantastic. And unfortunately, September 28th, this is what ended up happening. And the thing about Hurricane Fiona is if you were anywhere in the path, you experienced damage. Very, very few people didn't. Once again, I bring that up because it was similar to that with the market. There was very little place to hide last year when it came to both the stock and the bond market. And so I want to illustrate it this way. So this is a graph that shows the bond index. This is the the Bloomberg rather, aggregate bond index. And typically when the stock market goes backwards, there's a flight to safety and people move to more safe assets like bonds. And so typically stocks and bonds work in opposite directions. That's typical. However, last year, the bond index was down double digits. It was down 13%. And if you were in the 20-year government treasury index, the total return was negative 31%. So a significant decline in what we normally would refer to as quite safe assets. And then we throw in the S&P 500, and it did significantly better than treasuries, 20-year treasuries, and not that much worse in the whole scheme of things than the aggregate bond index. And then the NASDAQ, well, that was down 32%. And we throw in the emerging markets index, that was down another 20, you can probably see it better than me, 22%. And then you're saying, well, what area was a safe haven last year? And there was really only one safe haven, and that would be the energy sector. The energy sector, while everything else got clobbered, was up 57.97%, almost 58% for the calendar year. So that really was the one place to hide. But if you look at the graph, you'll also see that if you made the mistake of sometime around the middle of the year after seeing a really huge rise in the energy sector and you decided that you want to load up your portfolio with that, you actually would have lost money throughout the end of the year. So it was really the tale of the energy sector doing very well through the middle of the year and then a decline after that. And from that point forward, there was really no asset class that really showed any significant positive return. Now, you might be wondering, well, why didn't we just throw everything in energy at the beginning of the year? And so what I thought I would then do is show you the comparison between the S&P 500 in purple and the energy sector, the New York Stock Exchange Energy Sector Index over the last 10 years. And it's quite evident that energy has not been, even after up to 2021, it had been a horrible place to put your assets. You'd have been down almost 33% over that time frame, where instead you'd be up 182% over the last 10 years in the S&P 500. And so that's the reason that we didn't just load up on that sector. Clearly, that would not have been a good place to put too much of your money over the last 10 years. So once again, you might be wondering, well, why didn't we know this was going to happen? And the reason why is because we don't have one of these. Clearly, there is no crystal ball. What we do have is the opinion of experts like economists who are usually pretty close with their forecasts. We also have the meeting minutes from the Federal Reserve. We have their FOMC meeting notes. And so what I thought we would do is just take a look at what economists, experts, and the Fed were all saying back in late 2021 and early 2022 about the market and their expectations on the economy. So January 3rd, Bloomberg released this article with the economic and market forecasts from some of the biggest names on Wall Street. And so here is just some of a sampling of what some of these smart people with good research teams, what they were expecting would happen in 2022. Excerpts rather from that Bloomberg article. Number one, Bank of America, it predicts robust GDP growth. They thought there would be 3 rate hikes in 2022, with the 10-year Treasury ending at 2. They were really off, so we saw it double that, more than double. BlackRock, we see another year of positive equity returns coupled with a down year for bonds. Well, they got that bond part right. Let's see, DWS expects strong and declining inflationary pressure in 2022. We now know that didn't happen. Goldman Sachs expected less impressive return for risky assets, but they still were not predicting any big pullback in equities. JP Morgan thought that last year would have been the year of a global recovery, the end of the pandemic, a return to normal conditions that we had prior to COVID. Let's see, Kempen, we are expecting, we're reasonably optimistic about economic growth prospects in 2022. Morgan Stanley, growth improves and inflation moderates. Their wealth department, we suggest a third scenario, a robust global recovery, a moderation of US growth and inflation, and more balanced monetary and fiscal policies. We can go on and on and on, but what's the point? The point is that nobody really expected what we saw, and if you look at each of these predictions, the majority of them were wrong. And so back in December, just shortly before that Bloomberg article, this is what some of the brightest minds on Wall Street were forecasting for the S&P 500 in 2022. The group average was 5120, which is where the S&P they felt like it would end. And so if we just average that out, they were expecting a 7% growth. However, now we know that instead of going up 20%, we actually went, I'm sorry, up 7%. The S&P actually finished down 20%. So that was a big, big fail. They were completely wrong. And if we go back to December of 2021, here's where the speedometers, the economic speedometers were coming into the year. Now, you've probably seen these before if you've been to any of our presentations, but this company, Rockdale, gives, or City National Rockdale gives their 6 to 9 month predictions on the 20 most important economic indicators. And they give them either a green for positive, a yellow for neutral, and a red for negative. And so coming in the end of 2021, they were there was not one negative. If you're wondering, by the way, what can happen when the Fed and the government pumps a lot of excess money into the economy, this is what it can look like: a very, very, very healthy economy. And then we come into February of 2022, and we had only one negative, and that was geopolitical risk. Well, with everything going on in the Ukraine and Russia, I guess that was evident. But besides that, the economic picture looked really, really strong. So that's the backdrop of what it looked like at the beginning of 2022. Now, another question that we're often asked is, why didn't we recommend halfway through the year that we get more conservative within your portfolios for the third quarter? And here's one of the reasons. This graph is really, really important. So there were only 6 times in history when the market was down more than 15% in the first half of the year. So it's not common what we just experienced last year. As a matter of fact, last year was the 4th worst year in the market's history for the first half of the year. However, in all of those 6 times that the market was down more than 15%, the market was up the second half of the year. And not just a little bit. I mean, you can see in 1932, the second half was up 56%, and 39, 14.7, then 6, then 15.3, then 26.7. So if history was on our side, we could look at this and say, well, if the average recovery, the second half, is about 23%, then we probably should stay invested and watch our portfolio recover with that. In addition, the market actually hit its bottom on June 16th and then started a pretty steady rise after that all the way to August the 12th. From June the 30th to December 30th for the second half, the S&P was only up 1.4%. So while it was up just a small, insignificant amount. Now, so that's what happened, but let's switch gears just for a minute and talk about Jerome Powell. Another question we get asked a lot is why didn't we know what the Fed was going to do in getting so significant, raising rates significantly last year, which is what hurt bond and most asset prices. Well, once again, as I said, we don't have a crystal ball, but what we do have the notes and the guidance that the Federal Reserve gives us. So what were they telling us about raising rates and the pace that they would raise them? So let's go back to December of 2021. FOMC releases a statement, and I'll read the highlighted part. They said supply and demand imbalances related to the pandemic and the reopening of the economy have continue to contribute to elevated levels of inflation. Progress on vaccines and an easing of supply constraints are expected to support continued growth in economic activity and employment, as well as a reduction in inflation. What are they essentially saying? They're blaming inflation on the pandemic. They need the supply chain constraints to be removed, and then they were expecting inflation would then begin to drop. That's what they felt. They also said the committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. In support of these goals, the committee decides to keep the target rate for the federal funds rate at 0 to 1/4 of a point. So we're in December of 2021, and the Fed is saying We have inflation, it's tied to COVID, but we're not going to do anything about it. We're going to keep the Fed funds rate at near zero. Then January 26th, a month later, comes along and they reiterate the committee decided to keep the target range for the Fed funds rate at 0 to 0.25%. With inflation well above 2 and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the Fed funds rate. So they're reiterating, yes, we recognize now that there might be a little problem, but we're not going to do anything about it yet, and we're going to keep our foot on the gas. So maybe think of a person who has a heart attack and they're rushed to the hospital, they're put on life support. At some point, it's time to take the person off life support. That stands to reason, because without the person begins to atrophy, and so But at what point were we going to take the economy off this federally induced life support? Well, they're saying coming into January, we're not ready to do anything yet. Let's fast forward. March 16th. Fed says inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. So they recognize that it's there. Then they said with the appropriate firming in the stance of monetary policy, the committee expects inflation to return to its 2% objective and the labor market to remain strong. And to support these goals, the committee decided to raise the target range for the federal funds rate to 1/4 to 1/2. The committee expects to begin reducing its holdings of Treasury securities and agency debt and inflation mortgage-backed securities at a coming meeting. So finally, they acknowledge that they have to slowly begin to raise rates, but they think that it's very possible to get right back to that 2% number. That was in the spring of the year. And what did they end up doing? Now, do you remember when I said that they were expecting to slowly begin to raise rates? Well, this at the bottom was that March 17th interest rate hike. But look at the different rate hikes after a 3/4, 3/4, 3/4, 3/4, 3/4, and 1/2. So they're telling us that they're going to have maybe 2 to 3 1/4 point rate hikes, and they did just the complete opposite. Now, do you remember that I said that the market actually hit a bottom on June 16th? Well, here's what I really want to focus on. On June 16th, the Fed finally does its first 75 basis point or 3/4 of a point increase. Now, you'd think that the market would just absolutely crash at that point. That's what experts were forecasting, but instead what happened? The market rallied from June 16th to August 16th, 17.5%. Now, what's interesting too is that you might not know this, but the Federal Reserve has over 400 economists with PhDs. I mean, these are literally the doctors of the economy. And they had forecasted 2 to 3 rate hikes. Instead, if we took those 1/4 point moves that they felt like there would be 2 to 3 rate hikes, then we really got 17 hikes with the last one 2 weeks ago. So the complete opposite of what they told us that they were going to do. So even the Federal Reserve had no idea that they were going to get as aggressive as they did at the beginning or even a 1/4 of the way through the meeting. Now, this is the now infamous Jackson Hole Fed Reserve meeting on August 26th, where Powell gave a speech and he said, finally acknowledging real inflation, he said, inflation finally has our attention and we need a Paul Volcker rate hike increase to stop it. So after all of the year and all the inflation that we were all experiencing, whether it was at the gas pump or whether it was at the grocery store or trying to buy a new vehicle or almost any asset, the Fed completely ignored it and didn't acknowledge it until August 26th. But when he talked about that Paul Volcker style rate increase, it's because of how aggressive the Fed had to get in the early 80s, late 70s and early 80s to try to tackle inflation.
Of course, inflation has just about everyone's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. And that brings me to the third lesson, which is that we must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay, as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So, these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done. Thank you.
So why was he saying that? Well, look at how reminiscent the inflation trajectory that we just experienced since COVID, how reminiscent that was to the 1970s. So here you can see the inflation that we saw in 74. The Fed began to address it. It caused pain. And so there was a lot of pressure on the Fed to kind of take their foot off the brake. And then we see inflation really peak coming into the late 70s. And that's when Paul Volcker decided we're going to take a knife and stick it in the heart of the economy to try to finally get rid of the inflation that we're seeing. And then in fairness, we saw relatively low inflation. We averaged 5% in the 80s and only 3% in the 90s. And about that 3% or a little under through the 2000s. And then we see COVID and look at the trajectory of inflation. So first of all, here's essentially what Jerome Powell said in that meeting. He essentially said inflation's bad and it's not going away anytime soon. Finally some truth out of the Federal Reserve. But the question is, are we going to need as much pain as what Paul Volcker and the Fed delivered to the US economy in the form of a recession in 1982 to finally to get rid of it? And that's what it sounds like the Fed essentially said, is that they're not afraid of some pain in order to bring it down. We can't see this continue, because if this continues to go up like this, then we're going to have some major issues. So finally, I guess what Jerome Powell and the rest of the Fed is doing, this is February's Bloomberg Business Week magazine, is they're finally having a stare down with the bull market. And so Wall Street is actually wanting the Federal Reserve to lower interest rates, to start to put the foot back on the gas and take the foot off the brake of the economy. See, by raising rates, they're trying to slow down the economy, thereby bringing down inflation. And while Wall Street wants that to happen, the Federal Reserve has been pretty clear that they have no interest in doing that, at least for the time being. What we've just experienced with the rate hikes that we saw last year is unprecedented in how quickly the Fed raised rates. If you go back to the last 7 aggressive Fed tightening cycles, including this one, which is here, you can see how long it's taken historically in raising rates, and over how long it's taken and how slow they've done it. Look at 2015, the rate hikes. And then we come into 1987 and 1994, and here was 1999. And so once again, left to right is how many months from the first rate hike they have continued to raise rates. Up and down is how high. And then you see that the last time that they raised in a one cycle that they raised rates as quick as, or I say as much as they did, was in 2004. However, that still took over 2 years for us to see interest rates where they are now. And in this case, they did it in about 9 months. The most aggressive rate hike ever. With inflation reaching levels that we've not seen in 40 years, the Fed, they originally took aim at a soft landing. You might remember that they continued throughout the spring talking about that soft landing, and they believed that there was a plausible path to bring down inflation without putting us into recession. And so that's the reason that they instituted all of these rate hikes, is to try to bring things down and get prices back down. Now, more rate hikes are clearly coming. The Fed's been clear about that, especially with CPI numbers that were released today. And but the good news is we don't expect them to continue probably in the 0.75% hikes like they've happened. Starting this year, we're expecting them to be slower rate hikes of around 0.25%. And we don't expect them to start to lower interest rates until hopefully maybe mid to late 2023, somewhere at least in the second half of this year. So I guess just to reiterate this, if you're wondering why the market did what it did and the economy did what it did, now you know. It's because the Fed aggressively, more aggressive than they've ever had, tried to slow things down to finally tackle inflation after completely ignoring it. If you look at inflation a different way, this is inflation going back to 2016, and you can see how low inflation was throughout most of that throughout COVID, really. And then you can see what's happened with inflation afterwards. And they obviously an 8% inflation is well above trend, and it's something that this has to be dealt with. So that's where that's how we got to where we were. So someone once said, you don't know where you're going unless you know where you're coming from. Well, now you know where you're coming from. A COVID-induced economic recovery like we've never seen before, which caused massive inflation, a Fed that completely ignored it, a government that printed money like it was going out of style. Approximately 40 cents of every dollar that's in circulation has been printed since COVID. So you flush the economy with that much money and you see this kind of inflation. That's how we got here. The question is, where are we now? What do those economic speedometers look now? Now remember, even in February of last year, there was only that one negative, and that was geopolitical risk, and 2 neutrals. Now be careful if you're with what I'm about to show you, because this is a massive change in the economic environment. This was January's economic speedometers. You can see that not only do we have the geopolitical risks that you can't see quite down here because of my picture, but you also have significant other negative economic indicators that has really, things have deteriorated coming into this year. That's on the economic front. But let's now talk about the stock market. So we are currently in the midst of a bear market. This is what's happened to the stock market since the beginning of last year. And you might say, well, this is unprecedented. Well, just a reminder that just going back to the dot-com bubble burst in March 24th of 2000, when the market hit a peak, we saw a 49% decline in equity prices. And then we had the financial crisis of 07, October 9th of 07 through March 9th of 09, a 57% decline. And then there was COVID. In just 5 short weeks, we saw a 34% decline. And then here is the 20% decline. Now, the other thing that I just want to key in on is after that huge fall, prior to the fall that we saw in 2000, that 49% decline, stocks were trading pretty expensive, 25.2 times earnings. And then there was that decline, and there was this decline, and then there was this decline. So I know for many of our clients, they feel like we've never been here before, but in reality, we have. It certainly was unprecedented in 1 calendar year, but we have seen these type of declines. And if you notice, the market has always recovered. It's always recovered. Now, if there's a positive thing about stock prices going down, is it's made them a lot less expensive than where we were. If you go back to January 3rd of last year, the PE ratio, or the price per earnings, forward-looking, stocks were trading at 21.4 times earnings, so pretty expensive. And with the decline that we've seen, they're now trading at 16.7 times earnings, so they just got significantly cheaper. But I'm going to zip through because I'm going to show you one other slide that just puts this in a different light. This goes back to 97, and what it just says is, our stocks, when you look at the price of them by earnings, are stock prices expensive, or are they cheap, or what is the 25-year average? The 25-year average for stock prices is 16.82 times earnings. And once again, you can see how expensive they got in late 99, and then this was the COVID effect, where stocks were pretty expensive. And then here is where we are today, or should say at the end of December of 2022, at 16.65 times earnings, so cheaper than what the 25-year average. So if there's an upside, it's that stocks have suddenly become, with the correction, have become less expensive when compared to earnings. So this is expensive, and to the right there, you can see now back to average. Also, when it comes to unemployment and wages, part of the reason that we've had this inflation is because of the unemployment rate. And you can see here that the 50-year average for unemployment has been 6.2%. And here we hit a high on unemployment during COVID that we haven't seen something like this in the last 50 years. So we went from averaging 6.3 to suddenly, this is what happens when the economy gets shut down by the government and we have a pandemic. But look at what happened leaving the pandemic. Look at what happened to the unemployment rate. That's the dark number. And we are now somewhere in the less than 4%, right around 3.5%. What that does when you have unemployment that is so low, it's hard to hire people because everybody's working. And so what do you need to do? You need to pay them more. This is average wage growth in the blue line at somewhere around 4, and look at how it's jumped up to 5.8%. That's great if you're working and you're getting paid more money, but that also means that suddenly McDonald's is hiring people for $20 an hour and giving them a $500 sign-on bonus to flip French fries. And that, who pays the cost of that? We do. Consumers pay higher prices for goods and services. So you've got this combination of all this money that was infused into the economy during COVID to keep it going in the form of the extra unemployment benefits and the PPP loan program and just the stimulus checks that were sent out. And then you tackle that with high unemployment and then all of a sudden record low unemployment and high wage growth. And suddenly we have got a massive problem with inflation. That's where we are currently. What did the effect of the Fed shooting rates up have on mortgage rates? You started 2022 where you could get a 30-year conventional mortgage for under 3%. And we ended the year with them being over 7%. That is, I keep using the word unprecedented when I talk about 2022. Once again, unprecedented. Never seen rates shoot up as fast as they did. And what did that do to, when rates were really, really low, it helped drive up house prices. And all of a sudden, now that interest rates are going back up, think about how much more expensive it is to get a mortgage. All of a sudden, now we're seeing the median national home prices begin to decline, which in the whole scheme of things, we need to see that happen, or home prices are just going to become, we're not going to be able to afford homes, right? How are you going to be able to afford a home if home prices continued? And if the rise in interest rates, which obviously are super tied to inflation, wasn't the biggest story, clearly mortgage prices were the biggest story, and which has really made our home prices begin to level off. So we talked about how we got to where we are. We talked about where we currently are. Let's look forward to 2023 and see what our outlook is moving into 2023. So here is, from our perspective, the realistic possibilities of where we feel like the economy could go. And I guess the first thing that we're going to say is that in any economic environment, there is, the study of economics is the study of a expansion and a contraction, and another expansion and another contraction. And our perspective is that there are several potential scenarios, and some of them are good. Yes, we recognize that economic momentum is slowing, but that's not inherently bad. We do believe that a recession is possible, and when growth slows, naturally the risk of a recession rises, but it's not guaranteed. We believe that U.S. fundamentals remain broadly strong and that they should provide some cushion in the face of growing headwinds like the inflation, energy costs, geopolitical uncertainty, just to name a few. So we feel like we're at the top side of a slowing economy with inflationary pressures weighing on us, and we can either continue to grow, albeit at a smaller pace, or we'll hit a mild to normal recession sometime in the second half of 2023. In our perspective, there's still room to grow, and that depends a lot on the actions of the Fed. So essentially, here's what we believe. We believe that there is probably a 20% chance that growth slows down but normalizes. That'd be the best case scenario. we think that there is a 30% chance that we go to slow growth, where the economy, instead of growing at 2 to 2.5%, grows at 1 to 1.5. We think that there's a 40% chance, the highest likelihood, that we do see a recession sometime in the second half of next year. But that would be a mild recession. And we think that there's a 10% chance of seeing a normal recession, not the best policy, possibility, rather. Now, what are some headwinds and what are some tailwinds that are going to affect where we are? Well, first of all, here are the headwinds. I skipped through the slide before, but I wanted to refocus on it. You can see that monetary policy is now tightened. That's a headwind for growth. Good for inflation, but for economic growth, it's a headwind. We've seen the yield curve invert. I'm going to talk in a minute about what that means and what that typically means for a looming recession. We've seen housing and mortgages start to stabilize, and so that's negative outlook the next 6 to 9 months. We all know what the story with interest rates, they're going up. The LEI is an index that tracks the 10 most important economic indicators, and then it weights them by importance. And that has now gone negative, which has been a good precursor to recession. International economic outlook is not even as good as U.S. economic outlook. And then we know that geopolitical risks, the bottom right one, we still have that. These are the financial indicators coming into 2023. So we do have some headwinds. Next headwind is inflation. It goes without saying that high inflation can cause a recession, like we saw back in the early 80s. Obviously, this is going to continue to be a headwind. 50-year average for headline CPI inflation has been 4%. The good news is, in October of 2022, we were at 7.8 annualized. And in November, 1 month later, we were at 7.1. So the good news is we are seeing inflation start to drop a little bit, which really is what we need to see. That's what we're watching the absolute closest. So what's the Fed forecasting for interest rates, and what is the market forecasting for interest rates? So what you're seeing in the black is the Fed funds rate. And then what is the Fed expecting for 2023? Well, they're expecting the unemployment rate to go up to 4.6%, and they think that will remain stable through 2025, still around 4.5. They think in the long run, unemployment should be in that 4% range. The estimate that the Fed has for year-end 2023, their forecast is that the Fed funds rate will continue to grow up to 5.1% before then beginning to decline. What does the market expect? The market does not believe the Fed. And why would we, after the Fed missed the boat so badly last year? They think that instead of going up to 5.1, that interest rates that the Fed should stop at around 4.59% and then should start to drop them throughout the second half of this year. So the Federal Reserve would like to see the long run interest rate, Fed funds rate, back at 2.5%, but they're acknowledging that they're still not done. They still have to continue to tackle inflation. Remember I said that the yield curve is inverted. What does that mean? It means that when long-term rates are lower than short-term rates, that's an inverted yield curve. So if you were to go out and buy a 3-year CD, you should expect to get less interest than a 5-year CD. Or if you buy a 3-year treasury, you should expect to get more than a 5-year. But when those go the opposite direction and the banks or treasuries or the bond market is offering higher interest rates for short-term money and lower interest rates for long-term money, that says that the bond market, the fixed income market, is expecting a softening economy, typically a recession, and they think that interest rates actually should decline, which is why they're offering higher interest rates for shorter periods, if that makes sense. So here is it on a graph. This graph is looking at two things. It's looking at 2-year treasuries in comparison to 10-year treasuries. And then in the orange, it's looking at 3-month treasuries in comparison to 10-year. And there's a line that runs right through the middle here that you can't quite see, and that's 0. And whenever these two lines drop below 0, that means that the yield curve is inverted. The gray bars up and down represent the last recessions that we've seen. We've had 1, 2, 3, 4, 5 recessions going back to 1980. The thing to note is that whenever the interest rates invert, they invert right before a recession. Inverted yield curves are the best predictor historically of a looming recession. Why are we pointing that out to you? Because here's where we are right here. Now do you start to see why we're expecting, if history is any guide, we're expecting, or at least the bond market is expecting, a recession in the next 2 to 6 quarters ahead. How does the S&P do during years of high inflation? Well, if you just look at last year, you'd say horrible, the stock market does horrible. Well, we had high inflation last year. But what this graph does is it looks at the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 times that we've had high inflation through the end of 2021. So this goes all the way back to 1922, and we've got 100 years of history here. And you can see that the market was actually up 1, 2, 3, 4, 5, 6, 7, 8 of those times. So high inflation does not necessarily mean that the S&P 500 will decline. The actual median, now it has in the past, as it did in 1974, where the market was down 26, or 73, where it was down 14, or certainly what we experienced last year. But it'd be a mistake to think that as long as we have high inflation, that the market cannot expand from here. So the question is, are we headed for recession? And if we are, what are some things that we need to make sure that we know about a recession? So first of all, what is a recession? So pundits commonly classify a recession as 2 consecutive quarters of declining GDP growth. The US economy shrinks. But there's some other important factors to consider, such as inflation, employment, and other economic indicators. Just as corporations experience general phases of growth and contraction, known as in the sum of their business cycle, the economy also experienced peaks and categorized as expansions and high unemployment and inevitable valleys, which are periods of declines known as recessions. Now, there's a government organization, NEBR, the National Bureau of Economic Research, and they're considered the leading authority on US economic issues. It determines whether the US economy is actually in an expansion or a recession. They determine that as a reoccurring period of decline in total output, income and employment, and trade, usually lasting from somewhere around 6 months to a year and marked by widespread contractions in many sectors of the economy. So using statistics, NEBR can calculate the precise start and end to recession. One thing to note, they're usually about a year behind in telling us when we went into recession. So their crystal ball is not exact, but they can look back and then they tell us whether or not we went into one or whether or not we came out. The shortest recession in history being what we just went through during COVID. So here is a reality check, what happens during a recession. It can be nerve-wracking for everyone, namely because unemployment levels rise across a variety of sectors within the economy, which means millions of people can lose jobs. This can create a real bad snowball effect where the economy gets worse and worse before getting better. Here's what can happen during a recession. First of all, unemployment rises. One of the first things that occurs is that we start seeing an increase in unemployment. It's because during the recessions, businesses cut spending because they're worried about the direction of the economy. And unfortunately, from cutting spending, they also cut employees because that's a big part of their expense. The second thing that happens is less spending. Employees are laid off. Their income is obviously affected. With little or no income, consumers are less likely to spend, so they put less money into the economy. And then what does the government do? The government debt increases because with all these people that were laid off, the government has to start to print money, and there's all of the unemployment benefits, and the size of the government debt grows as it tries to stabilize the economy. And obviously there's stimulus bills and different aid that's offered. The next effect typically is assets lose value. Stocks, homes can all lose value. And then the Fed then starts to lower interest rates again, slashing rates in an effort to stimulate the economy and get it going again. This makes it more difficult for businesses and consumers to take loans and during a down time. And so it puts more money into the economy, gets it back, helps get the market and the economy back on track when they lower interest rates. And then finally, you've got, which you can't quite see here, but then you've got difficulty finding jobs, and because you have all these people that lost jobs and they're looking for work. And for example, the boomerang generation, which was the 25 to 34-year-olds who suffered badly during the Great Recession that we saw through 07 through 09, some of them still living with their parents. So that's what happens during a recession. And if your last memory, totally understandable if any of us have a little bit of PTSD regarding the word recession, because if we ignore the shortest one that we experienced during COVID, the second longest recession would have been, or post-war recession, was the financial crisis. And so this chart up and down is the length of the recession, and then back and forth is the years that they took place. And the number here in the middle is the decline in the size of the economy. One thing that should jump out if you ignore the real short COVID recession, that this was the third worst recession in history, only second to the Great Depression and the post-World War II decline, where we saw a 12.7% decline in GDP. So if that's your last memory, then I get it if you're nervous and you hear that word recession. However, remember, these are things you need to know about a recession. Number one is that historically the S&P falls before the recession. And you can see that 6 months before the recession, in anticipation, we typically start to see a decline in the stock market. And then then during the recession, the market actually can improve. As a matter of fact, 1, 2, 3, 4, 5, 6 of the last recessions, the market was up. And in 4 of those, double digit during the recession. So it corrected before the recession, it expanded during the recession. Here's the big thing we want to focus on. How does the market do after the recession? 1 year afterwards, on average, the market is up 21.7%, 3 years up 49.7%. So the point is that if we jump out and we're not there, the market historically, only one time 1 year later was the market not up. And every other time it was up double digits. So important thing to remember about recessions. It's a misnomer to think that just because we have one, that the market is in a decline. We can't focus on this one here. We need to focus on the other ones. So what historically can happen to your portfolio? First of all, there have been 13 recessions going back to World War II, and the market was up 7 of those 13 times. Significant performance, up double digit, double digit, double digit, double digit, double digit. And this one, the market, the S&P was still up 4. This time it was up 7. Every other time out of those 7, the market was up double digits. Once again, we focus on this one, and that's understandable, 07 through 09. But just because we go into recession does not mean that the stock market has historically not expanded. As a matter of fact, odds are that they have. And we threw this chart in because people, we get the question from a lot of people, am I ever going to live long enough to see my accounts recover? Well, it depends on how much return you make. If someone says, I want to get really conservative and I'm satisfied to get a 6% return, then based on what the S&P did from the peak that we hit of 47.97 back in January 3rd of last year, it would take 5 years for it to recover. But it only takes 3 years if we're trying to get a 9.5% return and 1 year at a 26.7 return. And the point that we tried to make is that the market can recover. It historically always has recovered. That's the point that we really want to focus on. The other thing that this chart tells us is how long bull markets normally last and how long bear markets normally last, and what the stock market was during a bear market. The point is that bull markets significantly average a much longer return than, or a much higher return. Yes, the market goes back, but then it recovers. This is just looking at when there's a rebound, how much of a rebound do we historically see? And as you can see on Black Monday, which most of us remember, the 33.5% decline, the next 12 months, the market was up 21%. During the Gulf War, the market was up 29.1 12 months later. The monetary crisis in Asia, 12 months later, up 37%. Tech bubble up 33, financial crisis up 68, trade war up 37, and the COVID sell-off of 33% that occurred in 5 weeks, we saw a 77% recovery after that. What's our point? Is that stocks normally have stage a very, very strong recovery coming out of a cycle like we've just gone through. You might be feeling negative right now. I get it. The University of Michigan Consumer Confidence survey would agree with you in that that people right now are negative. This is simply says, what's the average? So basically, if we're below, if the index is below 85.6, that means more people are negative. If it's higher, more people are positive. And right now, this is where we finished the end of last year, which would be the 1, 2, 3, fourth lowest consumer confidence level that we've seen going back 50 years. The other thing that the chart tells us is be careful not to trust your emotions. Because just because consumer confidence is high doesn't mean that the stock market has a big positive return. You might recall Warren Buffett. He said, be fearful when others are greedy. Be greedy when others are fearful. So this looks at the last 8 times that consumer sentiment has hit a peak. 12 months later, from August 72, the market was down 6.2%. It didn't matter that everyone was positive. It did not mean it was good for stock prices. Next time, up 1, up 13, not bad. Down 2, up 4, down 4, down 2. And this was the COVID where this was the one anomaly. But if we look at when consumer confidence hits a trough, look at where the stock market is 12 months later, S&P 500, up 22, up 20, up 29, up 32, up 14, up 22, up 15, up 43%. Where we'll be a year from now? Obviously, it's difficult to tell, but if history's a guide, be greedy when others are fearful. That means things are on sale, and be fearful when consumer confidence is at all-time high. In other words, consumers should not trust their own emotion. For the sake of time, what are some tailwinds? Well, first of all, LPL Research is expecting inflation to begin to dip in 2023, almost in half of where it is now. From their mouth to God's ears, it would be this would allow the Fed to slow down their rate increases and take their foot back off the brake and allow the economy to start to do its own thing again. That's a tailwind for the economy to get inflation down. Next tailwind, it's that people right now are wealthier than they have been in history. Their assets are higher and their liabilities are not. And so the good news is consumer confidence, or consumers are flush with cash. And we at Fross and Fross feel like they have the assets and the net worth to be able to get through a soft recession, if indeed we do see one later on in this year. If you look at household debt service ratio, what is the percent of disposable income from the average American's house that goes to pay debt, whether it's a mortgage, credit card debt, car loans, that type of thing? What's interesting is that right now we are at the lowest point in over 40 years. Look at where 10.6% of Americans' households were going to pay debt of their income, disposable income was going to pay debt in 1980. And then this is the why we had the financial crisis. Suddenly people were way over leveraged. 13.2% of their money went to pay debt service. And look where we are now. After the financial crisis, people saved money. They paid off debt. They were a lot more fiscally responsible. And now we're the lowest with lowest debt service ratio that we've seen in 42 years. We talked about this chart before, but what's our point? Why'd we bring it back up? It's because stocks are back to historic levels. Stocks are no longer that expensive. They're at a 50-year average right now at 16.7 times earnings. So we don't have to worry about the stock market being too high. And what does that mean historically for stock prices? Well, this is where we are at 16.7 times earnings. The graph is trying to say that when stocks are super, super cheap or expensive, historically, how does the stock market do? Does it go up or does it go down? Every cluster here is a different year that's taken place in the stock market since the Great Depression. And you can see that when stocks are at around this price, that historically most of these clusters are that the stock market went up. There's only been a couple times where the market has gone down when we've seen stock prices at this current level. 5 years later, also on average, the market is up, and only a couple times here has the stock market been down. But most of these years, the stock market was positive. So we think that's a really good tailwind for the stock market. Just a reminder, just because we have a bad year in the market does not mean that the market finishes bad. As I said before, last year was a little bit more of an anomaly where we saw, and usually we can see a big sell-off and then there's a nice recovery. Sell-off, not that bad. There were two notable, or maybe three notable exceptions, and that would be the dot-com bubble era and the financial crisis and what we just went through. But that's not normal. When we see a decline in the market, usually that's a buying opportunity, not a selling opportunity. You might be wondering, what are the analysts predicting for this year? You can't quite see that because of where my camera is, but they are expecting an increase of 6% for the calendar year. So hopefully they're right and we see a continued recovery here in the stock market. I guess one of the takeaways that we had from this, I'll just say in conclusion, is that just like that hurricane, during the midst of a hurricane, it can be ugly and it can be scary, but the sun does come back out. And it can be that same way when we're in an economic cycle like we've just gone through. It can be scary, and we can think that it's too will never pass, but it always has passed. And so here's our encouragement from the entire team at Fross and Fross Wealth Management. We encourage you to focus on long-term goals. We encourage you to be an investor, not a trader, not trying to make a knee-jerk reaction. We've built your portfolio such that to plan for an environment like this, and jumping out of the plane is typically not the best scenario unless the plane's really going down. And we don't think now the plane is going down. We think that the worst of it was priced in last year, and that we think that there will be a continued recovery. What are we watching for? We're watching for inflation numbers. We need to see inflation start to notably come down. Once again, that's going to take the pressure off the Fed, and they will be able to then let things expand. It's been a crazy few years for us since COVID, as you can only imagine, and the volatility that we saw then, and then the recovery, and then the softening cycle that we saw last year. And I just want to say that from our perspective, we want to thank you very much for the trust that you've put in our entire firm. We opened our new office in Brownwood last year, and those of you that live down there or close to there, if you want to meet with us there, we'd be more than happy to meet with you as well. We've lost some, I will say we've lost some really good friends because of COVID. We lost some really good villagers that didn't make it. And it does put things in perspective, what the really, really important things in life really are. We're always honored when you don't keep us a secret and you tell your friends and your neighbors about us. Right before COVID in February of 2020, we all went on a retreat, my entire team, and we rebuilt our mission statement. And essentially the mission statement says, at Fross and Fross Wealth Management, we believe that our clients have unique needs and they deserve an advocate. That's our job. It's our job to be an advocate for you. We exist to provide financial confidence through knowledgeable, independent, and ethical advice. Friends and Fross and Fross Wealth Management, friends and family investing in life together. Let us be your advocate. Let us help steer you down this uncertain path and get you to the other side. on behalf of the entire team, have a super day. I hope you enjoyed the video. Once again, as I said at the beginning, if you have any questions whatsoever, you can no doubt tell my passion. And I want to make sure that we all at our firm want to make sure that you know exactly what our thoughts are. Remember, we're investors. We're not traders. Everyone have a wonderful day. Thank you.